This is Taking Stock on Bloomberg. I'm Pimm Fox. Unilever's planned purchase of Sara Lee's shower gel and European detergent businesses, it's hitting a snag at the European Union. The EU's antitrust agency wants to review the $1.5 billion deal, which they say could create significant numbers of product overlaps. A spokesperson for Unilever says that they remain confident a deal can get done by the end of the year. Here to give us a little bit more insight into what's happening at Sara Lee and whether the food market happens to be a hot spot for investors, Alexia Howard of Sanford Bernstein. Alexia is among the top-ranked analysts on Kellogg, Kraft, and Campbell's Soup. Alexia, good to have you with us as always. What's happening at Sara Lee? We know that there's been a change at the top. Brenda Barnes leaving the company to recover from a stroke, and now you have this sort of seeming hurdle at the European Union.
There's a lot going on at Sara Lee right now. The company's been going through the process of divesting its household and body care business for most of the last year, and the Unilever deal, which was announced last, fall of last year, is the biggest piece of it. It's all the body care business. It's Radox shower products in the UK. It's Sanex skincare in France. So it's a pretty big deal. And we had some suspicions that there might be some areas of the EU where there was too much product overlap and where the EU might actually raise some reservations. We obviously don't know exactly what those are or how material they are as yet, but it could take a few months to really work that all through.
Are these uncertainties something that investors ought to be mindful of in terms of buying the shares of Sara Lee, or is there something else at work?
I suspect that the deal will actually go through. You often see these kinds of snags, and it's usually just a matter of timing rather than actually completely undermining the deal. So I expect the deal to go through, but there may be some bits that they have to sell off in the meantime. The bigger concerns about Sara Lee are they're right in the middle of this commodity cost inflation that's reared its ugly head again in the last month or two.
This having to do with wheat prices as well as coffee prices.
Absolutely. So they've got wheat, they've got coffee, and they've got meat. Those are Sara Lee's three big businesses, and they're all up significantly year on year, and we've seen them rising further in the last few weeks.
So what happens? Do those costs get passed along to the consumer? We've talked about how a lot of the grocer and retailers have been cutting back on promotions, and they're making the actual producers of the products eat literally whatever price increases they would pass on to a buyer.
I think by and large in a lot of those categories, particularly the meat category, Sara Lee's got contracts with the customers, the retailers, to be able to pass on prices, but the big unknown is how the consumer's going to react. So if it really starts to hit into volumes, that could start to hit their margins, hit their top line growth through the course of this year.
How about the effects of having very strong brands? I read a report recently having to do with whether people are going to be buying strong branded products, or when you talk about Sara Lee, people don't really necessarily look at bread because that's a big part of their business. They don't say, well, it's a Sara Lee branded bread, we've got to buy that over a generic brand or a local brand.
I think the problem that Sara Lee has is not that its brands aren't strong. If you look at the European coffee brands, or you look at something like Hillshire Farm or Jimmy Dean, they're all strong brands. The problem that Sara Lee has is that the bread business, and to a lesser extent meats, are quite fragmented. So you're right, they're lower margin businesses, particularly bread. And while Sara Lee, as a brand in bread, has done really well through innovation over the last several years, you're right, it's very hard to really get ahead in that market and really drive the margins upwards.
Sounds like you're neutral on the shares of Sara Lee right now. You're staying on the sidelines.
Right now, I would keep an eye on it. We're going to have pressure on margins over the next couple of quarters at least. So there might be a good entry point, maybe 6 to 9 months from now, but I'd hold off for right now.
I'm glad you mentioned margins because I want to get your thoughts about margins at Kraft. Margins have been doing pretty well. It was, I think, the sales. Everyone was kind of worried about whether sales were going to keep pace.
Yes, and so this latest quarter, the really good news was that margins were way up. They look in very good shape to be able to deliver their sort of $2.30 or so in EPS for 2011. But you're right, the top line growth, the organic sales growth slowed down from about 3% and a bit to 2.2% this quarter, and everybody got a little worried. The good news here is that we had consumer takeaway data that literally came out yesterday, and for the first time in many, many months, I think we're probably talking about 18 months now, Kraft's market shares were up marginally for the first time, as I say, in quite a while now, and the volume data was strengthening. So I think there's some encouraging news there. This could be the beginning of the turn to the positive side for sales on Kraft.
And how is the integration going with Cadbury? You mentioned in your most recent report about savings in terms of headquarters of Cadbury, also some combinations in the biscuit and cookie business in Europe, and also what's happening in chocolate. How's the integration going?
Seems as though it's going fairly well. There's obviously pockets of concern here and there. The good news is that they've got a lot of costs that they can take out of the system, particularly in Europe, and we saw that very clearly in the last quarter's earnings results for Cadbury. We've seen very strong growth in gum here in the US, a little bit of patchy gum growth here and there across the world, but generally it seems to be going fairly well. I guess the encouraging thing here is that now that here in the US, Walmart's bringing a lot of its stock-keeping units back, those SKUs that we've all been worried about for the last year, now that those are coming back, that really should start to help Kraft's top line going forward.
So you still like the shares of Kraft right now?
Absolutely, yes.
And when you look at the business of Kraft right now and this integration that's going on, are they going to have to spend more money marketing in order to reinforce all their brands?
I think the opportunity here is for Kraft to really go after revenue synergies. So there's certain markets like Russia where Kraft is pretty strong but Cadbury is quite weak, and you see the reverse happening in many areas in Latin America. So Kraft does want to bump up the marketing spending. We're going to see it go up a fair amount, but it's really to get the top line growing in those new opportunities.
Trying to boost those sales. All right, I want to thank you very much, Alexia Howard, coming to us from Sanford Bernstein, expert always when it comes to Sara Lee, Kraft, and the food companies.